The global economy looks alive, markets are open, profits are reported, growth is announced. But what if none of it is real growth? What if the world did not become richer, only more leveraged? What if prosperity was replaced by postponement? And what if the system did not heal after crisis, but learn how to survive without ever recovering? This is not the story of a collapse. It is the story of an economy that learned how to live without progress, and why that decision changed everything. 1.5. The global economy appears stronger than ever. Headline numbers show expansion. Markets hover near historic highs. Corporate earnings beat expectations, and governments celebrate resilience. Yet beneath this surface of apparent prosperity lies a contradiction that defines the modern era. Growth is everywhere in statistics, but almost nowhere in lived reality. Productivity struggles to accelerate. Real wages lag behind asset prices, and entire generations feel poorer despite working longer hours in more advanced economies. This is not a temporary anomaly. It is the result of a fundamental shift in how growth itself is generated, measured, and understood. For most of modern economic history, growth was rooted in something tangible. It came from industrial expansion, technological breakthroughs, population growth, and rising productivity. When economies grew, societies felt it. Incomes rose alongside output. Consumption expanded because households earned more, not because they borrowed more. Debt existed, but it followed growth rather than replacing it. That relationship has now inverted. Over the past several decades, the world has quietly crossed a threshold where growth no longer reflects increasing productive capacity, but expanding balance sheets. Measured output continues to rise, yet the composition of that growth has changed dramatically. A growing share of reported expansion comes not from producing more goods or delivering more valuable services, but from financial activity, asset inflation, and credit expansion. When governments stimulate demand through borrowing, when corporations increase earnings per share through leverage and buybacks, and when households maintain consumption through credit rather than income, the economy appears to grow even as its foundations weaken. The numbers move upward, but the engine driving them no longer creates durable wealth. This divergence became especially visible in the years following the global financial crisis. Central banks responded to collapse by pushing interest rates to historic lows and injecting liquidity on an unprecedented scale. These measures were initially framed as emergency interventions. Over time, they became permanent features of the system. Cheap money flowed into financial markets, lifting asset prices far faster than wages or productivity. Stock indices recovered quickly, housing markets rebounded, yet median income stagnated, labor participation weakened, and productivity growth slowed across advanced economies. What followed was not a return to normal growth, but a redefinition of growth itself. Expansion was increasingly measured by asset valuations, market confidence, and financial stability, rather than by improvements in productive capacity. As long as markets rose and credit flowed, the economy was considered healthy. This created a dangerous illusion. Rising asset prices were treated as proof of prosperity, even though they benefited a narrow segment of society and were driven largely by monetary conditions rather than economic fundamentals. Global data reinforces this pattern. Productivity growth across major economies has trended downward for decades, even as total output expanded. Real wage growth failed to keep pace with inflation in many sectors, while household debt reached record levels. Governments accumulated obligations that would have once been considered unsustainable, yet faced little immediate consequence due to suppressed interest rates. The economy learned to function without resolving its structural weaknesses, relying instead on ever cheaper credit to sustain momentum. Recent global events have only accelerated this transformation. Supply chain disruptions, geopolitical tensions, and large-scale fiscal responses introduced even more liquidity into the system. Trillions in new spending supported demand, but much of it flowed into asset markets rather than long-term productive investment. Inflation surged not because economies suddenly became more productive, but because demand was sustained in the absence of corresponding supply growth. The response was once again financial rather than structural, reinforcing the cycle. This is where the illusion becomes most dangerous. Traditional economic indicators continue to suggest expansion, but they increasingly reflect financial engineering rather than real progress. When growth is driven by debt, it borrows from the future to sustain the present. The economy appears stable only because its obligations are rolled forward rather than resolved. Each new cycle of stimulus becomes less effective, requiring larger interventions to achieve the same visible result. Growth persists, but it becomes fragile, dependent on constant support. The modern economy did not lose its capacity to grow, it lost its patience. Instead of investing in productivity, infrastructure, and long-term innovation, it optimized for short-term stability and market confidence. Credit became the tool that filled the gap between expectations and reality. Growth statistics remained intact, but their meaning changed. Expansion no longer guaranteed rising prosperity, only rising leverage. Hashed meta. Pause. Sex 1.5. This is the world we now inhabit. An economy that looks strong yet feels weak. A system that grows yet does not enrich. A model where numbers improve while confidence erodes. The credit boom never ended, because the moment it does, the illusion breaks. And the longer it continues, the further the economy drifts from the foundations that once made growth real. Hashed meta. Pause. Sex 1.5. Money used to be a signal. It transmitted information about scarcity, risk, time, and value. Interest rates told borrowers how expensive capital was. Credit spreads reflected confidence or fear. Prices moved in response to supply, demand, and productivity. For decades, this signaling mechanism allowed capital to flow toward its most productive uses, rewarding efficiency and punishing waste. That system no longer functions as it once did. Money still circulates, but it no longer communicates truth. It transmits policy. Hashed meta. Pause. Sex 1.5. The transformation did not happen overnight. It unfolded gradually, then suddenly, as extraordinary measures became ordinary practice. Central banks once existed to smooth cycles and preserve stability. Today they operate as permanent market participants, shaping outcomes rather than responding to them. Interest rates that were once considered emergency tools became structural features. Quantitative easing, initially designed to prevent collapse, evolved into a standing mechanism for maintaining asset prices and financial confidence. Hashed meta. Pause. Sex 1.5. At the core of this shift is the disappearance of price discovery in capital markets. When the cost of money is artificially suppressed for extended periods, it no longer reflects risk or productivity. Capital becomes abundant not because opportunities are plentiful, but because constraints have been removed. Borrowing expands not because returns justify it, but because the penalty for leverage has been minimized. In such an environment, money ceases to act as discipline, it becomes lubricant. This change altered behavior across every level of the economy. Governments learned that deficits no longer carried immediate consequences. With interest rates near zero, borrowing appeared painless. Debt servicing costs declined even as total obligations exploded. Fiscal restraint became politically unnecessary, even undesirable. Large-scale spending programs were justified not by long-term productivity gains, but by the assurance that financing would remain cheap and available. 1.5. Corporations adapted just as quickly. Instead of investing heavily in innovation, capacity, or labor, firms increasingly directed borrowed funds toward financial optimization. Share buybacks replaced capital expenditure. Balance sheets expanded not to grow productive output, but to enhance per-share metrics. Earnings growth became less about operational performance and more about leverage and accounting efficiency. Markets rewarded this behavior, reinforcing the cycle. Households, too, were drawn into the transformation. Low interest rates encouraged borrowing for consumption and housing. Asset prices rose faster than incomes, pushing individuals to take on more debt simply to maintain their standard of living. Home ownership became less a function of savings and more a function of credit access. Consumption remained strong not because wages surged, but because financing filled the gap. This is how money stopped being money in the classical sense. It no longer represented stored labor or future production. It became a policy instrument, deployed to stabilize sentiment rather than allocate resources. The economy shifted from a system governed by incentives to one governed by intervention. Stability replaced efficiency as the primary objective. Economic data from recent decades illustrates this shift with clarity. Productivity growth slowed across advanced economies, even as financial assets surged. Investment increasingly favored real estate and equities over manufacturing or infrastructure. Capital flowed toward speculation rather than innovation, not because it was irrational, but because the system rewarded it. When risk is underpriced, risk-taking becomes mandatory. The global response to successive crises accelerated this process. Each shock reinforced the belief that markets would be supported regardless of fundamentals. Liquidity injections grew larger, faster, and more frequent. What once required justification became expected. The financial system adapted accordingly, pricing in permanent intervention. Volatility declined not because risk vanished, but because it was absorbed and redistributed by policy. This created a paradoxical environment. Markets appeared calm even as underlying fragility increased. Debt levels climbed, but distress remained muted. Failures became rare, not because businesses were stronger, but because they were sustained. Inefficiency persisted because it was affordable. Creative destruction, once a driver of growth, was replaced by preservation. The consequences of this shift extend beyond finance. When money loses its signaling function, economic decision-making becomes distorted. Capital misallocation increases. Productivity stagnates. Inequality widens as asset holders benefit disproportionately from financial expansion. The economy grows dependent on conditions that cannot be normalized without disruption. Yet normalization itself becomes impossible. Raising interest rates threatens debt sustainability. Reducing liquidity risks asset repricing. Policymakers find themselves constrained by the very tools they deployed. Money cannot return to its former role without exposing the fragility it has concealed. 1.5. This is the environment in which the modern economy operates. A system where money flows freely, yet meaninglessly. Where prices rise, yet signals fade. Where stability is engineered, but resilience erodes. The transformation of money is not a technical detail. It is the foundation upon which the endless credit boom rests. As this new monetary regime solidified, its influence began to reshape not only markets, but expectations themselves. Investors, corporations, and governments internalized a single assumption: liquidity would always return. Every downturn would be met with intervention. Every shock would justify accommodation. Over time, this assumption stopped being questioned. It became embedded into models, strategies, and political promises. Risk was no longer something to be priced. It was something to be managed by someone else. This shift fundamentally altered how capital evaluated time. In a traditional system, long-term investment demanded patience. Returns were uncertain, and failure carried consequences. In the new environment, time itself was compressed. Short-term performance mattered more than durable value creation, because markets learned that unfavorable outcomes could be deferred. Debt could be refinanced. Losses could be socialized. Liquidity could bridge almost any gap. The future became negotiable. The result was a slow erosion of productive investment discipline. When capital is cheap and abundant, efficiency becomes optional. Projects no longer need to generate strong returns to be viable. They only need access to financing. This dynamic favored scale over productivity and leverage over innovation. Large institutions thrived because they were perceived as systemically important, while smaller, more efficient competitors struggled to compete for capital. The economy rewarded size, not performance. Hashed meta. Sex 1.5. At the same time, the boundary between monetary policy and fiscal policy blurred. Central banks expanded their balance sheets to levels once thought unimaginable. Government bonds were absorbed by monetary authorities at massive scale, reducing market discipline and anchoring yields artificially low. This arrangement allowed governments to expand spending without confronting the immediate trade-offs that once constrained fiscal behavior. Political cycles grew detached from economic cycles, insulated by intervention. Global coordination amplified these effects. When one major economy eased policy, others followed to prevent currency appreciation and capital outflows. This synchronized accommodation created a worldwide environment of suppressed yields and inflated asset prices. Capital flowed freely across borders in search of return, further disconnecting financial markets from domestic economic conditions. Growth appeared global, but it was increasingly financial rather than productive. Sex 1.5. The distortion extended into labor markets as well. Cheap capital favored automation, consolidation, and financial optimization over human investment. Wages became a cost to be minimized rather than a driver of demand. Productivity gains that did occur often failed to translate into broad income growth, instead flowing into profits and asset appreciation. The economy expanded, but its benefits concentrated upward, reinforcing inequality and social tension. 1.5. As debt accumulated across all sectors, the system grew more sensitive to interest rates. Small changes in financing costs carried outsized implications. This sensitivity constrained policy options even further. Any attempt to restore traditional monetary discipline risked triggering defaults, asset repricing, and recession. The economy became trapped in the narrow corridor where intervention was required simply to maintain stability. Global news cycles reflect this fragility with increasing frequency. Every tightening attempt sparks market stress. Every slowdown prompts renewed calls for stimulus. Policy responses grow faster, larger, and more complex, while their effectiveness diminishes. Each intervention buys time, but at the cost of deeper dependence. The system survives, but it does not heal. This is the hidden cost of money that no longer acts as money. When prices cease to convey risk, when capital is detached from productivity, and when stability is prioritized over resilience, the economy loses its capacity for self-correction. Growth continues, but it becomes hollow. Expansion persists, but it rests on confidence rather than capability. The world has learned to live without real growth by redefining growth itself. As long as liquidity flows and markets respond, the illusion holds. But illusions require constant reinforcement, and the longer money remains a policy tool rather than a signal, the greater the adjustment when reality reasserts itself. The credit boom did not persist because it was sustainable. It persisted because the system no longer knows how to function without it. Credit was once a bridge between present effort and future reward. It allowed households to smooth consumption, businesses to invest ahead of revenue, and governments to finance projects whose benefits unfolded over time. In this framework, debt expanded capacity. It pulled growth forward, but only because that growth was expected to arrive. Credit was subordinate to productivity. That hierarchy no longer exists. Today, credit is not supporting growth, it is replacing it. This transformation did not occur through a single policy decision or crisis. It emerged gradually as economies faced slowing productivity, aging populations, and political resistance to structural reform. Instead of confronting these constraints directly, the system discovered an alternative path. Borrowing could sustain demand without requiring income growth. Leverage could generate returns without requiring efficiency. Refinancing could postpone reckoning indefinitely. Credit stopped being a bridge and became the road itself. The clearest evidence of this shift appears in the behavior of consumption. In classical growth models, household spending rises as incomes rise. In the modern economy, consumption increasingly outpaces wage growth. The gap is filled by credit. Consumer loans, mortgages, and revolving debt allow spending to remain strong even when purchasing power stagnates. This supports headline growth figures, but it does so by advancing future income into the present. Each cycle of borrowing maintains momentum at the cost of future flexibility. Housing markets provide a particularly revealing example. In many economies, home prices have risen far faster than incomes for decades. This divergence should have constrained demand. Instead, it expanded debt. Longer maturities, lower down payments, and cheaper financing allowed buyers to stretch further. Housing became less affordable, yet more expensive. The apparent contradiction was resolved through leverage. Growth continued, but it was anchored to debt expansion rather than income growth. Corporations followed a similar path. Faced with moderate demand growth and intense competition, firms turned to credit as a substitute for organic expansion. Borrowing funded acquisitions, financial engineering, and balance sheet optimization. Returns improved not because output surged, but because leverage magnified earnings. Investment in productivity-enhancing capital lagged behind financial activity.
The economy grew, but its productive base did not expand proportionally. Sex 1.5. Governments institutionalized this model. Public debt expanded as fiscal deficits became normalized. Infrastructure spending, social programs, and crisis responses were financed through borrowing rather than taxation or reallocation. In theory, such spending could raise long-term growth. In practice, much of it sustained consumption and stabilized demand, without materially improving productive capacity. Growth appeared resilient, but it depended on continuous fiscal expansion. 1.5. Global economic data reinforces this pattern. Debt-to-output ratios climbed steadily across advanced and emerging economies alike. Total obligations grew faster than real output, yet growth rates did not collapse. Instead, they stabilized at modest levels, supported by credit expansion. This stability was interpreted as success. The deeper implication was ignored. The economy was consuming future growth to sustain present stability. Financial markets adapted quickly. Investors learned that growth no longer needed productivity to persist. As long as credit expanded, earnings and asset prices could rise. Valuations decoupled from traditional fundamentals. Debt-funded demand supported revenue. Low financing costs justified higher leverage. The system became self-reinforcing. Credit created growth, growth validated credit. This dynamic reshaped expectations. Recessions became shallower, but recoveries weaker. Each downturn was met with faster and larger intervention. Credit expansion filled the gap left by structural weakness. The economy avoided collapse, but it also avoided renewal. Instead of resetting, imbalances accumulated. Each cycle began with higher debt and lower resilience. The substitution of credit for growth altered the time structure of the economy. The present gained priority over the future. Decisions favored immediate stabilization over long-term investment. Political incentives aligned with this preference. Borrowing delivered visible benefits without immediate costs. The consequences were deferred beyond electoral cycles. Debt became the path of least resistance. International dynamics intensified the effect. Countries that resisted credit expansion risked slower growth and capital outflows. Those that embraced it maintained competitiveness and financial stability. A global equilibrium emerged where restraint was punished and leverage rewarded. The credit model spread not because it was optimal, but because it was necessary to keep pace. This is how the economy learned to grow without growing. By redefining growth as demand supported by borrowing rather than output driven by productivity. The numbers improved. The system appeared stable. Yet beneath the surface, the productive engine weakened. Credit filled the space where real expansion should have occurred. The longer this substitution persists, the more difficult it becomes to reverse. Debt creates obligations that constrain future choices. Growth that relies on borrowing requires ever greater leverage to sustain itself. Each additional unit of credit produces less real activity than the last. Diminishing returns set in, not as a sudden collapse, but as a slow erosion of effectiveness. This is not merely a financial phenomenon. It is a structural transformation. Credit has become the primary source of momentum in the global economy. It sustains consumption, supports valuations, and stabilizes demand. But it does so by borrowing from a future that grows increasingly fragile. The economy moves forward, but it does so by pulling tomorrow into today, leaving less room for genuine growth to emerge. As the reliance on credit deepened, the economy began to display a subtle but critical transformation in its internal mechanics. Credit no longer merely supported demand. It began to define it. Entire sectors adjusted their business models around the assumption that borrowing would remain cheap, abundant, and continuously renewable. Profitability became less dependent on selling more goods or delivering better services, and more dependent on maintaining access to financing. The boundary between solvency and growth blurred. Seconds 1.5. This evolution can be observed in how balance sheets expanded faster than operations. Corporate leverage increased even in periods of economic expansion, a reversal of historical patterns where firms deleveraged during good times. Debt accumulation ceased to be countercyclical. It became structural. Borrowing persisted regardless of growth conditions, not as a response to stress, but as a strategy for survival and competitiveness. Companies that refused to participate risked falling behind, not because they were inefficient, but because they lacked financial amplification. The substitution of credit for growth also altered the nature of risk itself. In a productive economy, risk is tied to uncertainty about future output. In a credit-driven economy, risk shifts toward refinancing conditions. The primary question becomes not whether an investment will generate value, but whether liquidity will remain available long enough to roll obligations forward. This reframing compresses time horizons and concentrates systemic vulnerability around financial conditions rather than real performance. As a result, financial cycles grew increasingly disconnected from economic cycles. Markets responded less to productivity data and more to policy signals. Inflation expectations, interest rate guidance, and liquidity announcements carried more weight than employment quality or capital efficiency. The economy became reflexive, reacting to anticipated intervention rather than underlying fundamentals. Growth narratives adjusted accordingly, emphasizing resilience and stability while avoiding deeper structural questions. Meta, pause, sex, 1.5. Global statistics reflect this distortion with increasing clarity. Each additional unit of debt generates progressively less output than the one before it. The marginal productivity of credit declines as leverage rises. This is not an abstract theory. It manifests in slower trend growth despite unprecedented levels of borrowing. The system runs harder simply to stand still. Credit fills the gap left by fading productivity, but it cannot reverse the trend. The social implications of this model are profound. When growth depends on borrowing, access to credit becomes a primary determinant of economic participation. Asset owners benefit disproportionately as rising prices enhance collateral values and borrowing capacity. Those without assets face higher costs and greater precarity. Inequality widens not as a side effect, but as a structural feature of credit-driven expansion. Growth persists, but it becomes exclusionary. Governments find themselves locked into the same dynamic. Public finances grow increasingly sensitive to interest rates and market confidence. Fiscal policy loses flexibility as debt servicing absorbs larger shares of resources. Political discourse shifts away from long-term reform toward short-term stabilization. Structural challenges are acknowledged but deferred. Credit provides a temporary solution that becomes permanent through repetition. Meta, pause, sex, 1.5. At the global level, this model creates fragile interdependence. Capital flows respond rapidly to changes in monetary conditions, amplifying volatility across borders. Emerging economies become particularly vulnerable, forced to balance growth aspirations against external financing constraints. The global system appears integrated, but it is unified primarily through debt rather than trade or productivity. Each crisis reinforces the substitution. Shocks that once might have triggered restructuring instead prompt renewed borrowing. Failures are postponed, imbalances accumulate. The economy survives by extending its obligations, not by resolving them. Over time, the cost of avoiding adjustment rises, even as the capacity to absorb it diminishes. This is the quiet paradox at the heart of the modern economy. Credit sustains growth by compensating for its absence. Stability is preserved by sacrificing resilience. The present is protected by narrowing the future. What appears as continuity is, in reality, a controlled delay. The system does not collapse because it is constantly reinforced, but reinforcement requires escalation. Each intervention must be larger than the last. Each expansion of credit must offset a deeper structural shortfall. The economy moves forward through momentum rather than strength. This is how credit became the substitute for real growth, not through deception, but through necessity. The model persists because abandoning it would expose the gap between financial expansion and productive reality. As long as credit can bridge that gap, the illusion holds. But the bridge grows longer, heavier, and more fragile with every cycle. The system eventually reaches a stage where movement becomes mandatory, not because growth is strong, but because stopping would expose how fragile it has become. This is the phase where the economy can no longer tolerate pause, correction, or restraint. Every slowdown threatens stability. Every tightening risks fracture. What once were policy choices turn into obligations. The system must keep moving, not forward in real terms, but outward in scale. At this point, intervention stops being a response to crisis and becomes the condition for normality. Markets do not wait for recessions to demand support. They react preemptively to any signal of restraint.
Expectations harden around the idea that policy must remain accommodative at all times. Growth targets, employment goals, financial stability, and political credibility all converge around a single requirement: liquidity must continue. This dynamic creates a permanent asymmetry. The cost of tightening becomes immediate and visible, while the cost of easing is delayed and diffuse. When interest rates rise, asset prices react instantly. Debt servicing costs increase. Weak balance sheets are exposed. Political pressure intensifies. When liquidity is added, the benefits appear immediate and reassuring. Markets stabilize. Growth resumes. The long-term consequences remain abstract. Faced with this trade-off, the system consistently chooses continuation. Economic history once relied on cycles to restore balance. Downturns cleared inefficiency. Bankruptcies reallocated capital. Recessions, while painful, renewed the productive base. In the modern framework, this mechanism is suppressed. Failure is treated as systemic risk. Correction is interpreted as instability. Preservation replaces renewal. The economy avoids collapse, but it also avoids healing. This creates a population of entities that survive not because they are productive, but because they are supported. Companies roll debt forward indefinitely. Governments refinance obligations rather than reduce them. Financial institutions price assets on the assumption of intervention. The distinction between solvent and insolvent blurs. Viability is defined not by cash flow, but by access to funding. Global data reveals the scale of this transformation. Debt levels continue to rise relative to output across nearly every major economy, yet defaults remain historically low during expansionary periods. This is not evidence of improved fundamentals. It is evidence of accommodation. The system absorbs stress by extending maturity, lowering rates, and expanding balance sheets. Risk is not eliminated, it is postponed. As a result, policymakers lose degrees of freedom. Each intervention narrows future options. Interest rates cannot normalize without triggering repricing. Balance sheets cannot shrink without reducing liquidity. Fiscal consolidation becomes politically unviable in an economy dependent on stimulus. The system enters a corridor where only one direction feels safe. Forward motion becomes compulsory. Global events amplify this constraint. Geopolitical shocks, demographic pressures, climate transitions, and supply disruptions all increase volatility. Each shock reinforces the argument for continued support. Emergency measures stack upon one another, gradually redefining the baseline. What was once extraordinary becomes assumed. The threshold for action lowers. The scale of response grows. Markets adapt accordingly. Risk premiums compress. Volatility is suppressed. Asset prices decouple further from underlying cash flows. Investors focus less on valuation and more on policy signals. Strategy shifts from analysis of fundamentals to anticipation of intervention. This feedback loop tightens the system's dependence on continuous motion. The labor market reflects this rigidity as well. Employment is stabilized through fiscal transfers and monetary accommodation rather than productivity growth. Jobs are preserved, but wage growth remains constrained. Participation rates struggle to recover fully. The economy maintains activity, but not advancement. Motion replaces progress. At the same time, political narratives adjust to sustain the model. Growth is framed as resilience. Debt is framed as investment. Stability is framed as success.
Structural reform is acknowledged rhetorically but postponed in practice. Credit fills the gap between promise and delivery. The system survives on alignment between expectation and intervention. Sex 1.5. This is the moment where stopping becomes impossible. Not because the system is strong, but because it is leveraged against its own continuation. Any attempt to slow risks revealing the accumulation of deferred costs. Any attempt to normalize threatens the architecture built on accommodation. The system must move, because standing still would force a reckoning. The paradox is that continuous motion increases fragility rather than reducing it. Each cycle of support stabilizes the present while weakening the future. Each delay compounds the adjustment that will eventually be required. The system grows larger but less flexible, more connected but more brittle. This is not stagnation in the traditional sense. Activity continues, markets function, consumption persists. But the underlying structure loses adaptability. Growth becomes something that must be maintained rather than generated. Momentum replaces momentum's source. In this phase, the economy is no longer governed by choice. It is governed by constraint. The system cannot stop because it has learned to survive only by extending itself. Forward motion is no longer progress. It is necessity. As the system locks itself into perpetual motion, the consequences begin to surface in subtle but irreversible ways. The economy no longer responds proportionally to stimulus. Each new intervention delivers diminishing impact, yet requires greater scale. What once restored confidence now merely prevents panic. The margin between stability and stress narrows, leaving policymakers with less room to maneuver and markets with greater sensitivity to every signal. This dependence reshapes institutional behavior. Central banks shift from guardians of stability to managers of expectation. Forward guidance becomes as important as action itself. Markets trade not on data, but on interpretation. Words move trillions. Silence creates volatility. The credibility of institutions becomes intertwined with their willingness to intervene. Restraint is interpreted as neglect. Discipline is perceived as danger. Fiscal authorities face similar constraints. Budgetary expansion becomes structurally embedded, not as a countercyclical tool, but as a baseline requirement. Public spending stabilizes demand, supports employment, and offsets private sector weakness. Yet as debt accumulates, fiscal space erodes. Servicing obligations consumes growing shares of resources, even in an environment of suppressed rates. Governments remain solvent, but increasingly inflexible. The financial sector internalizes these realities. Banks, funds, and institutions adapt their models to a world where policy backstops are assumed. Risk management evolves around tail events rather than fundamentals. Liquidity becomes the primary concern. Asset allocation favors instruments most responsive to intervention. The distinction between investment and speculation fades, replaced by positioning around policy regimes. Global coordination intensifies the trap. When major economies remain accommodative, deviation becomes costly. A country that tightens prematurely risks capital flight, currency appreciation, and domestic slowdown. Synchronization emerges not from agreement, but from constraint. Monetary independence weakens. Global liquidity conditions dominate local fundamentals. The system becomes more unified, yet less resilient. Economic statistics increasingly reflect this distortion. Output grows modestly. Employment remains supported. Inflation fluctuates but resists control. Productivity fails to accelerate meaningfully. The gap between financial performance and real economic progress widens. Growth exists, but it lacks depth. Stability is achieved, but at the expense of adaptability. Social pressures accumulate beneath the surface. Asset inflation benefits those with capital, while wage earners face rising costs and stagnant purchasing power. Trust in institutions erodes as official narratives diverge from lived experience. Political polarization intensifies. The economy functions, but belief in its fairness weakens. Stability without inclusion breeds fragility of a different kind. Each new shock tests the system's capacity to respond. The response arrives quickly, decisively, and at greater scale than before. Yet recovery feels thinner. Confidence returns, but optimism does not. Markets rebound, but conviction fades. The economy resumes motion, but without momentum rooted in productivity or innovation. This is the culmination of a system that cannot stop. Intervention preserves continuity, but it also deepens dependence. The longer motion is maintained through support, the harder it becomes to imagine an alternative. Adjustment is deferred not because it is unnecessary, but because it is intolerable. Eventually, the question is no longer whether the system will change, but how. Continuous motion delays reckoning, but it also shapes its form. The longer constraints dominate choices, the more abrupt future transitions become. The economy survives by extending itself, but survival is not the same as strength. In this state, growth is no longer a destination. It is a requirement imposed by the structure itself. The system moves because stopping would reveal what has been postponed. Forward motion continues, not as progress, but as preservation. Eventually, the bill for living without real growth begins to arrive, not as a single crisis, but as a slow and uneven redistribution of cost across society. The economy does not collapse under the weight of debt. It adapts. And in adapting, it quietly transfers pressure away from balance sheets and toward people, institutions, and social cohesion. The price of endless credit is not paid all at once. It is paid continuously, in ways that are easy to normalize and difficult to reverse. Sex 1.5. The first visible cost emerges through purchasing power. When growth relies on credit rather than productivity, prices adjust faster than incomes. Asset inflation outpaces wage growth. Housing, education, healthcare, and basic services become more expensive relative to labor. Official inflation metrics fluctuate, but lived inflation becomes persistent. Households experience rising costs even when aggregate data suggests stability. This divergence erodes trust in economic signals and institutions that rely on them. At the same time, labor loses bargaining power. In a credit-driven system, demand is stabilized through policy rather than income growth. Employment is supported, but wage pressure remains contained. Firms prioritize financial resilience over compensation. Productivity gains, where they occur, flow disproportionately to capital rather than labor. The result is an economy that remains active, yet fails to deliver upward mobility. Work sustains survival, not advancement. Wealth distribution reflects this imbalance with increasing clarity. Asset holders benefit from rising valuations fueled by liquidity and leverage. Those without assets face higher entry barriers and greater exposure to debt. Credit becomes both opportunity and trap. It enables participation in the economy, but only by committing future income. Inequality widens not through deliberate design, but through structural mechanics. Growth persists, but its rewards concentrate. Governments absorb another portion of the cost. Public debt expands as states compensate for weak private sector income growth. Social spending rises to stabilize households. Infrastructure investment is framed as future-oriented, yet often serves short-term demand support.
Fiscal policy fills gaps left by the productive economy, but in doing so, it inherits its fragility. Debt servicing becomes a permanent consideration. Policy flexibility narrows. Financial stability itself becomes a public good requiring constant maintenance. Markets grow dependent on intervention. Volatility is suppressed, but risk accumulates beneath the surface. Price signals weaken. Capital allocation becomes less efficient. The economy functions, but it loses its capacity for self-correction. Stability is achieved, but at increasing cost. Global data reinforces these trends. Productivity growth remains subdued across major economies. Debt continues to rise faster than output. Each unit of borrowing generates less incremental activity than before. The system compensates through scale. Larger interventions replace smaller ones. Longer horizons replace shorter ones. The economy does not regain momentum. It sustains motion. International dynamics further complicate the adjustment. Countries compete not through productivity, but through financial conditions. Currency management, capital controls, and synchronized policy responses become tools of stability. Trade flows persist, but underlying competitiveness weakens. Global growth becomes a collective exercise in balance sheet expansion rather than innovation. Social consequences accumulate quietly. Younger generations face delayed wealth formation. Home ownership becomes less accessible. Long-term planning becomes riskier. Trust in institutions erodes as outcomes diverge from promises. Political systems respond with polarization rather than reform. The economy remains intact, but its social contract frays. The critical insight is that none of these outcomes require collapse. The system can persist for long periods under these conditions. Credit allows adaptation. Policy absorbs shocks. Markets adjust. But persistence is not the same as sustainability.
The longer the economy lives without real growth, the more it restructures itself around that absence.
At some point, growth ceases to be the goal. Stability becomes the objective. Avoiding disruption takes precedence over creating opportunity. The economy measures success by continuity rather than progress. This shift is subtle but profound. It redefines what prosperity means and who it serves. This is the true cost of the endless credit boom. Not a dramatic failure, but a gradual narrowing of possibility. The economy survives by lowering expectations. It functions by redistributing pressure. It maintains order by trading resilience for control. Growth continues, but it no longer lifts. It sustains, it preserves, it delays. The bill is paid not in defaults alone, but in diminished futures, in choices constrained by past borrowing, in societies that grow accustomed to less upward movement. The economy does not break, it settles, and in settling, it reveals the quiet price of learning to live without real growth. As the system settles into this new equilibrium, its final cost reveals itself not through shock, but through limitation. The economy continues to operate. Markets open each day, transactions clear, and institutions function. Yet the range of possible futures narrows. Choices that once existed disappear quietly. Policy becomes reactive rather than visionary. Strategy gives way to maintenance. The economy remains alive, but it stops evolving. In this environment, time itself becomes distorted. Long-term planning loses relevance because the future is already encumbered. Governments plan within debt constraints rather than developmental horizons. Corporations prioritize survivability under financing conditions rather than innovation under competition. Households make decisions based on affordability under credit rather than opportunity under income. The future is no longer a space for growth. It is a ledger of obligations. This distortion reshapes how risk is perceived. In a healthy system, risk is associated with uncertainty and reward. In a credit-saturated system, risk becomes associated with deviation from stability. Anything that threatens continuity is treated as danger. Reform becomes risky. Adjustment becomes destabilizing. The safest path is repetition. The system optimizes for predictability, even when predictability locks in underperformance. Economic data begins to reflect this stasis. Growth rates cluster within narrow bands. Productivity fails to accelerate despite technological advancement. Innovation occurs, but its impact diffuses slowly. Capital is available, yet cautious. It flows toward assets that preserve value rather than projects that create it. The economy grows older, not wiser. Global comparisons highlight the same pattern. Regions with vastly different demographics, cultures, and resources converge towards similar outcomes. Moderate growth, high debt, inflated assets, constrained policy. Diversity of models diminishes as financial conditions dominate structural differences. The global economy becomes synchronized not by success, but by limitation. The social response to this environment evolves gradually. Ambition adjusts downward. Expectations recalibrate. Stability becomes a substitute for progress. Generational optimism weakens as mobility slows. Trust in institutions erodes not because they fail dramatically, but because they deliver less than they promise. The gap between effort and reward widens, quietly but persistently. Political systems reflect this tension. Debate focuses on distribution rather than expansion. Conflicts arise over allocation of constrained resources rather than creation of new value. Policy cycles shorten. Long-term reform is postponed in favor of immediate relief. Credit remains the preferred instrument because it postpones conflict by postponing cost. Eventually, the economy reaches a point where the question is no longer how to grow faster, but how to avoid shrinking. Preservation becomes success. Survival becomes achievement. The language of prosperity shifts accordingly. Resilience replaces ambition.
Continuity replaces progress. This does not mean collapse is inevitable. Systems can persist under constraint for extended periods. Credit can sustain activity. Policy can manage volatility. But persistence under constraint produces a specific outcome: an economy that moves but does not advance, a society that functions but does not ascend. The final cost of living without real growth is not insolvency, it is inertia, the loss of dynamism, the quiet acceptance of limits imposed not by resources but by accumulated choices. The economy becomes efficient at maintaining itself, yet increasingly incapable of transforming itself. This is the end state of the endless credit boom, not crisis but compression, not failure but narrowing. The system survives by trading potential for stability, future for present, strength for continuity. And in doing so, it reveals the true price of growth that never truly existed. The credit boom never ended. It simply became invisible. The question is no longer when the next crisis will arrive. The question is how long an economy can move forward when it is no longer driven by productivity, innovation, or real growth, but by borrowed time. If this analysis changed how you see growth, debt, and stability, stay with this channel. Because the most dangerous systems are not the ones that break suddenly, but the ones that function perfectly right up until they no longer can.